Welcome to Nasdaq Trade Talks, where we meet with the top thought leaders and strategists in emerging technologies, digital assets, the regulatory landscape, and capital markets. I'm your host, Jill Malandrino, and joining me on the desk at the Nasdaq Market Site, we have Chris Dearborn, Managing Director on the Nasdaq Market Intelligence Desk, as well as Anthony Saglimbene. He is Chief Market Strategist at Ameriprise Financial. We're here to discuss why stocks largely reflect a let's wait and see what happens approach. It's great to have the both of you with us. Welcome to Trade Talks. Anthony, it's interesting. If you take a look at the S&P 500 year to date, we are up 2.6%. If you look at what's happened in between, it tells a very different story, not that necessarily chill, calm, 2.5% when we are now.
Yeah, I mean, when you look at the quarter, I mean, we're on pace, at least the S&P 500 is on pace for its best quarter since the first quarter of 2024. And I think that would surprise a lot of investors, particularly given the type of volatility that we saw and some of the declines that we saw across a lot of the major averages in April. I think what's happened since then is the White House has walked back some of the most extreme tariff announcements. They've given more time for negotiations and trade talks. We saw really decent numbers on an economic perspective. We saw really good first quarter earnings numbers. And I think investors have decided in May and as we move through June to just take a wait and see approach on tariffs. And they've brought back major averages back to levels before we saw some of these most extreme tariff announcements.
Yeah, and Chris, I think as it relates to the economic data, the questions that will be answered over the next couple of months is, was this demand pulled forward in anticipation of tariffs? Because it feels as if the market and investors are digesting headlines a little bit better than perhaps corporates or the macro environment is perceiving the uncertainty. It's an interesting dichotomy.
It is. If you sat on, as an investor, if you sat on your hands for the entire time of since April 2nd all the way through, you're actually doing okay. If you panicked and you sold and you bought back, if you're a little bit more active, you would have definitely been hurt here. If you're putting new money to work, there's definitely inflection points, April 9th. And then when Trump walked back tariffs on China recently, May was one of the best months in years. The NDX had a great month. Tech, communications, discretionary, all up 9 to 10%. Earnings, as you said, Anthony, knocked out of the park. The hard data continue on the economic side. If you put on your economic hat, the hard data continues to be pretty decent, right? The soft data has been very negative and starting to come around a little bit. That's the sentiment scores that we're seeing. And you're seeing investors kind of getting used to the rhetoric that comes out of the sledgehammer, that's the White House, about what they want to do. You're 1 minute away from something blowing up. Just look what happened the other day between Trump and Elon, right? That definitely hurt stock. So it's kind of curious to see where it's going to go. You're one headline away from blowing this all up or sending it to the other direction. The S&P at 600, the Nasdaq trading very well. We just need small caps that can come up a little bit more. Again, that's going to come with the interest rates that are going to come due. If we see cuts this year, hopefully it's for the right reasons and not for the wrong reasons. And if it's for the right reasons and they start to reduce, if the CPI numbers come in line tomorrow, 0.2% month over month, that'll be okay. The only thing, some of the hard data that's kind of people haven't talked about, if you look at the non-farm payroll report, the revisions that we saw for the previous 2 months, the markets would have traded completely different if those were the actual numbers. You saw a reduction of 95,000 jobs between the 2 previous months taken off the board. Markets would have traded very, very differently that way because the other data, JOLTS and some of the other data was showing that there was a slowing in hiring. Now, still good numbers, 143 and 135, but not the 170 something that we saw for the previous month.
Right.
So if the hard data can be trusted, then I think we're in a very good place. If the inflation continues to creep down a little bit, we're in a very good place. Do I think it was pulled forward? Absolutely.
Yeah.
I think a lot of it was. So let's see what the demand is. Can they keep going? I don't know.
Chris, we heard it on commercials. I believe it was Hyundai, maybe
Ford,
maybe Volkswagen, but I remember Hyundai in particular where we are aligned with our customers. We promise to keep our prices where they are on MSRP until June 2nd or 3rd was the date. I mean, if that's not somewhat telegraphing, that's why I'm curious to see what the data looks like over the next couple of months. But this goes back to your point earlier, Anthony, when you think about time horizon and a longer term frame of mind, even if you stayed invested, like we saw during COVID, like we saw in 21 and 22, yes, you might be flat, year to date, but guess what? You acquired a lot of shares at a discount in your 401k or your retirement accounts just by staying invested.
For sure, and I think investors, there's obviously the macro concerns of tariffs and inflation, and what does that mean for cyclical sectors of the economy? What does that do to employment trends? And I think there's a stew of uncertainty out there, and I think you mentioned a lot of really good points. I think what also was really moving markets down in the beginning of the year and certainly into those April tariff announcements was some loss of confidence in technology and the secular tailwinds of AI, the profitability that's generating for big tech companies. And since December, you saw a lot of those big tech, Magnificent Seven companies get hit really hard. And it just happened to coincide with a lot of fear about growth and tariffs and inflation. But what we saw in April was investors took advantage of some of the great opportunities they saw in technology. I mean, the Nasdaq was off into a bear market, down 20% or more. Some of the Mag 7 stocks were down 30% or more. And I think there was a switch that flipped during the Q1 earnings season when a lot of these companies reported not only did they have really good first quarter earnings, but their outlooks around CapEx spending in AI and overall technology very strong, and it gave investors the confidence to go buy these high quality secular growth leaders in the US economy on sale. And that's what they did in a lot of April and in May.
And I think CapEx remaining where it is a key part of the story because of course, CapEx is what sets you up for future growth. But in fairness, when we talk about valuation, international, as an example, was outperforming U.S. even before the tariff tantrums, the Liberation Day, whatever we're calling it. And it was a purely valuation story because the risk was to the upside there.
Yeah. I think part, and especially in the first couple months of this year, that American exceptionalism trade kind of came and dealt with a lot of the tariffs and slowing growth. And I think international markets like Europe and Japan were easy go-to areas, not only for investors to look at, kind of hide out of what's happening here with tariffs, but as you mentioned, valuations were good, earnings were okay, and you had dividends coming there, and I think investors wanted to hide out from the technology, which Europe and Japan doesn't have a lot of exposure to those companies. But what happened in that April 8th drawdown and from April till now, what's leading markets? It's the US, it's growth, it's technology, it's communication services, it's the secular growth leaders in the American economy, and I think that's what investors have turned back to after, as markets have rebounded since the April 8th.
So Chris, on the market intelligence desk, you guys are talking to our Nasdaq listed issuers, companies all day long. Yes. You particularly in the consumer sector. Yes. Anything that you can give us some insight into in terms of how management teams are perceiving the environment and the consumer, which is such a big part of the GDP here in the U.S.?
So a couple things. We'll start with the retail trade, going back to Anthony, what we're seeing. So you're seeing retail investors, a number of the different broker large houses have put out notes recently saying that they're seeing remarkable retail inflows as international investors sell US, which puts a little volatility into the market and creates a lot of opportunity. So you're seeing retail investors jump in, that buy the dip mentality is still out there. The question then comes in, where's we going to go from here? So on the consumer side, with what I'm dealing with, you're seeing a lot of those consumer names just get pummeled, especially in April. Supply chain issues, uncertainty around the tariffs you can't model out. You're pulling guidance. A lot of companies pulled guidance. And traditionally, if you have issued guidance in the past and you're pulling future guidance for next year, you generally get hurt, right? So that, again, putting you on sale. So what we're seeing with the consumer names is, especially in the retail space, is that the larger companies are weathering the storm much better because they can take price, they don't have to pass it on to keep their margins because they have scale with their suppliers. The smaller names that can't are getting hurt because they are raising prices and people are looking for other alternatives. They're going to the big boxes and you're seeing a lot of the larger names there do well. However, the operators who are in between, those mid-cap names that are doing very well, 5, 7, 10, $12 billion companies who have a good management team that are managing well, are being well rewarded because they're a little bit smaller, they're off the radar, you don't hear them as much mentioned on TV, but there's a good space there. Restaurant names, flipping over to that side, it's a hit or miss item, We're still missing the lower part of the income table. Those folks still are not going out to eat, they're cooking at home. So you're seeing a little bit of growth there from the staples companies that are supplying up at the restaurants. The trade down there, some of them are doing well, but most of them are still kind of hurting. There's a few that are doing well, but most of them are really hurting. But the staples names are that trade's starting to unwind a little bit now too, because that was a great trade. When you're uncertain, you want to preserve your cash as an investor. What are you going to do? You know what, I'm not going to spend. So think about COVID, when you saw that pent-up demand come out, when people were able to go spend, wages are still rising, right? Unemployment's relatively stable at 4.2%, even though if it's rounded down, if it was a real number for last month was 4.244, which is the highest since October of 21.
Right.
So realistically, it's a big number, but the participation rate is down. So there's a lot of moving parts in there. So if the unemployment rate stays the same, if layoffs remain relatively calm, people are going to come out of this over the summer if we have a tariff agenda, at least, put in place with China and some of the others. People are going to go back out and spend, and that's going to be good for the economy. It's going to be great for the GDP.
The bill is an outlier as well. You need to remove that piece of uncertainty.
There's a lot there.
So, Anthony, in the first quarter of 2025, S&P companies repurchased $283 billion. That's nearly a 27% increase from the same period last year. This is according to Moomoo. Does that suggest that companies see value within their share prices?
Absolutely, yeah, absolutely. I think companies took advantage. I mean, obviously they have buyback shares that go on for multiple quarters, but the timing of that and when they execute that is sometimes up to those companies. And I think companies in aggregate took advantage of some of the dislocations that we saw earlier in the year. And I think it's kind of a signal to investors that management has confidence in their business. And when you strip out some of these macro concerns and some of these tariff issues, as Chris mentioned, the consumer stands on firm ground. Corporate profitability is strong. These companies have been managing their costs well. Yes, they might have to shift things around due to tariffs, but overall, conditions for businesses and consumers are strong. Balance sheets are strong. And so as a CEO and executive team, why wouldn't you buy back your shares when you see dislocations if you believe in the quality of your company? And I think that's what we saw.
And it goes back to your point before about these mega cap tech names, these companies, Apple, Meta, Alphabet, NVIDIA. Those are the ones that were leading the way with buybacks. So that in my mind, it signals confidence.
It also helps the PE.
Right.
Right? I mean, right? That's the big question, right? You've got the price move, what's the earnings going to be?
Yeah.
Right? So if you just reduce the number of shares, that definitely plays into it.
Yeah.
And for the larger companies, that's a boon, especially in the Mag 7.
And for sure, I mean, the earnings, that helps manage their EPS, but a lot of these tech companies, their revenues were strong, and you can't manage that as much. That's based on real demand and fundamentals in their businesses, and so you get the combination of better EPS and better sales.
Right. I mean, the AI boom is still going, right? We're just at the baby steps of it right now. The amount of growth that we're going to see there over time is going to be a huge, huge leader for the entire market, just like it pulled us out the last 2 years. Mag 7, before that FANG, were the leaders in the market that carried all the other indices to the time, all-time highs. Right now, that's coming back a little bit. It may spread out a little bit more. I mean, discretionary is still doing very well, but some of the Mag 7 names are in the discretionary bucket.
Right.
Right? They're doing very well. Communications, same thing with the reorganization of GICs. Some of those names are in the communications sector. It's no surprise that tech, communications, and discretionary are the leaders because of the weighting of those stocks in those indices.
Yeah, but Chris, what's interesting with the AI trade, and where I think it's a little bit different than just the Mag 7 in isolation, the AI trade is going to transcend across every sector.
It is.
Why do you think, even if you look at the deal environment, energy and utilities were the, the most active for the first quarter, which indicates to me, Anthony, that this is more of it's more broad-based than just the isolation of the Mag 7. You're gonna have to be able to satisfy this demand, and that comes from energy, industrials, utilities.
We are in the early innings of an AI boom, and FactSet kind of goes through a lot of the corporate transcripts, and what they found in first quarter earnings transcripts is that the mention of AI was at a record across industries. And so as we've been focused on technology and in the kind of the shovels and the builders of AI,
the cloud and everything. Yeah.
What we're likely to see over the coming years is more industries, more areas adopting AI, using that technology to create efficiencies in their business, right? Become more profitable, connect disparate systems in their own organizations to be smarter about what they're doing. And those are the things that we're in very, very early innings of understanding. And so, yes, maybe there'll be cycles of boom and bust in some of the tech areas, semiconductors, software, but the benefits of AI will translate across industries over time.
Yeah, it's so interesting. You know, it's relatively new in the grand scheme of things, but I can't imagine doing certain functions of my job without AI. It makes you wonder, you know, how did you do some of it before? I mean, you can just see the efficiencies across not just our organization, but organizations in general, which, you know, a little bit a different topic. That's what makes cybersecurity so interesting because, you know, it also opens up some vulnerabilities. But I feel like AI, it's
there's great
everywhere.
potential. There's great potential. It's not always going to be right. Like anything else, you know, you have to learn by your mistakes, right? That's why you have a lot of times if you go to summarize it, looking for data to pull things in, spot check it, you have to reread it. That's not right, and it corrects itself. That's the best part about it. It corrects itself. So the next time you look for those topics, or if you want to summarize item, or if you want to pull data for you, if you want to create a formula for you, it's doing it better each time. So that's only going to take time. Think of it, you know, from pre-K to K to grammar school. We're not even in grammar school yet. We're still in kindergarten, maybe graduating the first grade in this. We're nowhere near an MBA.
But even from the advisory perspective, I want to wrap it on this, you know, sometimes, you know, not always the quickest adopters, you know, in financial services, insurance is another example. But as you're leveraging these tools, I mean, doesn't it give you more time to think about more creative ideas for your clients or actually spend time with your clients and eliminate some of the work that, you know, if you have created PowerPoint, you could save 2-3 hours just by having it put together, you know, the format, and then you get better ideas.
It does, and I think financial services is a good example, right? There's a lot of different functions across banking and financial services, whether you're an advisor, you're in research, or you're trading. AI can help you be more efficient in delivering whatever you're doing in those particular areas. And I think over time it allows you to spend more time in the areas that help either create revenue or generate more research or generate better trading execution. These are the things that AI will help with. And Chris, I think about the ecosystem is if you have all these systems connected that are helping you be more efficient, give you better answers, it's really important to protect that data. And so cybersecurity becomes another really important function within the AI ecosystem.
All right, appreciate both of your insights. Thanks for joining us on Trade Talks, and thanks for joining me from MarketSite. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.